We recently published our 2020 outlook for European structured finance, covering trends in both issuance and credit performance. In the securitisation market, we expect investor-placed volumes to remain steady at close to €100 billion after declining 5% last year. In the European covered bond market, benchmark issuance rose by 8% in 2019, and an increase in scheduled maturities could support a further 5 to 10% rise in volumes for 2020. Looking ahead, one positive for securitisation issuance is that the long-running regulatory uncertainty, which caused a drag on issuance for several years, should no longer hold back supply. Market participants have had to comply with the EU's new securitisation regulation for over a year now. But in the early days of the new regime, significant elements of the required market infrastructure and implementation guidance were still under development, keeping many originators and investors on the sidelines. Now, though, the new rules have bedded down and much of the uncertainty has lifted, supporting issuance. Central bank policy is another important factor. Bank-originated structured finance volumes in Europe have been depressed for several years, given the availability of cheaper funding options offered by the ECB and Bank of England. In the UK, the story here is potentially positive for issuance in 2020. The Bank of England's funding schemes have been closed to new drawdowns for nearly 2 years, and the maturities of past borrowings are on the horizon. We estimate that about £17 billion will mature in the second half of this year, with significantly more to come in 2021. As a result, UK bank issuers could once again start to tap debt markets in greater volume, as they plan for the gradual runoff of that term funding from the official sector. However, it's a different story in the Eurozone, where the ECB's equivalent funding scheme has now reopened to new drawdowns, allowing banks to refinance past borrowings rather than coming back to the capital markets. Finally, a word on securitisation credit performance. In terms of rating upgrades and downgrades, we expect performance to remain broadly positive in 2020. This chart shows the average number of notches of movement in our ratings, positive or negative, over a trailing 12-month period. For most sectors, this measure has been positive for at least 3 years, indicating that ratings have generally been moving higher. Even in the CMBS sector, where credit performance has been weaker, that measure turned positive in October 2019 for the first time in more than a decade, as most legacy transactions have now run off. Despite some concerns over the length of the current credit cycle, there are so far few signs of deterioration in underlying collateral performance for transactions backed by lending to consumers. However, one area of focus is the gradual deterioration in collateral credit quality in the CLO sector, with more recent transactions backed by loan pools that have lower ratings and recovery prospects on average than in earlier vintages. To read our full 2020 European Structured Finance Outlook report, please visit our website. Thank you.